How much passive income do I need to retire is a thought that might have run through your mind once or twice, or maybe all the time. I get it. The daily grind has got you down and you're looking for an escape. And the idea of waiting until you're 65 years old, that's got zero appeal. So let's take a look at how much passive income you need to retire right now. You ready? Let's go. All right, let's cut to the chase. You're wondering how much money you'll need in passive income to retire, and likely comfortably, without being dependent on a job, family, church, or state. If that's you, you're my type of peeps. Work smarter, not harder, and ultimately not work at all. If you don't want to, of course. So let's look at why a traditional approach ain't gonna cut it, why passive income is your only option of real retirement. And then we'll wrap it up with how you can actually pull it off for yourself. Oh, and by the way, if you're still looking to get that first deal under your belt, I put together a free training just for you to help you get that first deal done. And then how to earn $5,000 a month, flipping contracts and properties, working as little as 1 hour a day. And you can access it at mattsfreetraining.com. All right, first thing, that traditional advice that you get from retirement experts and financial planners, that 10% rule, saving 10% of what you earn over a lifetime, how that's gonna enable you to live comfortably in retirement. You've heard that before, right? Well, the truth is that unless you plan to retire abroad, you're gonna need a substantial nest egg to generate enough passive income to enable you to retire with that plan. And saving 10% in most cases is just not enough, because the truth is, we're all living much longer than we were when they came up with that 10% rule. And realistically, most people just don't make enough to save enough for that plan to pan out. Per the Department of Health and Human Services, that plan has failed 95% of today's 65-year-olds. But what about Social Security? Well, while the government assures us that Social Security benefits will be around when it's time to retire, it's best not to rely too heavily on others when planning how to live out some of the most vulnerable years of our lives. The average retirement benefit for a retired worker at the time of this recording is just over $1,600 a month. That's it. Even with inflation-based increases each year, you're not retiring with that. Not unless you pull 3 roommates together, and that's not likely how you want to spend your golden years. $1,600 per month is not even a significant supplemental income. Social Security, forget it, it's play money. But saving 10% of a lifetime's worth of your salary certainly has to amount to something, right? Well, intuitively, it feels like it should work out. That's why most people follow this advice. But very few people actually do the math to know for sure whether or not it will work out for them. And you don't need a degree in higher math to figure this out either. Basic high school math is enough to show us that saving only 10% of your income isn't enough to retire. Let's take the median salary of about $48,000 a year. By saving 10%, your money would need to grow at a rate of 6.7% a year for you to retire 40 years from when you start, just to reach $1 million. But what if you don't have 40 years? What if you got a late start? In order to retire after 30 years of contributing, you would need an unrealistically high rate of return of 10.3%. In these situations, not only do you need to contribute more than 10%, but you also need to double it, and then some, to have that $1 million nest egg in 30 years. And if you did make it happen, how long would that $1 million last? Well, if you left your $1 million in a low-risk conservative investment returning 5% per year, and you wanted to live on, say, $7,500 a month, you'd be out of money in 14 years. So you better not live one day past your 74th birthday, or it's welcome to Walmart for you. It's no wonder 95% of retirees are struggling. They never had a chance. And for those that pulled it off, they live their final years terrified of running out of money before they run out of life. So, if you don't have the ability to save a pile of money high enough to produce a passive income that will carry you through your final years, what do you do? Well, if you'd like to hear that solution, let me know by smashing the like button. I know, dumb question, right? Well, YouTube tells me the more people that like this video, the more people they're gonna show it to. And people looking to take their foot off the gas at some point in life absolutely need to see this. So I appreciate you for liking the video and helping me spread the word. All right, so rather than focusing on the mountain of cash that we need to create the stream of cash to retire, let's flip that equation around and focus on the stream of cash first that we need to retire, and let the excess then build the mountain. Let's start with some math. A little math can go a long way. So a simple way to get an estimate of how much money you're gonna need for retirement is by calculating how much you spend monthly. Or ask yourself, what am I making now each month? If I maintained that, would it be enough for the rest of my life? If not, where does it need to be? I mean, you know what that number is. It doesn't have to be exact, and you don't have to commit it in stone either. You can change your mind as you go, but you already kind of know what you need to support the lifestyle that you want in retirement, right? And that's the first step, defining your monthly income number. The second step is to look at different options for generating passive income that can get you there. I mean, I recently put a video together outlining the different options for the average person, and I put a link to that video for you down below in the description so you can watch it later, just in case you don't like what I'm gonna share with you now. It's no secret that real estate has created more wealth for more people than anything else on the planet. And when it comes to creating passive income for more people, enough passive income that fully supports a lifestyle, real estate is the clear winner in that category too. And there are 3 popular ways that anyone can pull it off. The first way, the real estate investment trust, or the REIT. One of the easiest ways to earn passive income in real estate is to invest in REITs. Real estate investment trusts, these REITs, are very similar to mutual funds. Investors buy shares, they contribute money, and then they gain monetary benefit in return. In most cases, REITs are publicly traded investment opportunities and can be found on major stock exchanges, allowing you to quickly buy and sell online. With these real estate investment trusts, your investment is spread out over a portfolio of real estate properties. Now, REITs are required to return at least 90% of their income to investors in the form of dividends, and just like mutual funds, they are generally very easy to get involved in, making it a great passive income option for many investors. A downside to this investment opportunity is the lack of transparency and control on your investments, because REITs do not allow passive investors the opportunity to choose which real estate assets their investment goes into. Additionally, REITs will generate lower returns on average than other passive income real estate opportunities. And the other part of this, you're gonna need a significant amount of money for that passive income to amount to something. The second way is through real estate syndications. So unlike REITs, with real estate syndications, you are not investing in a fund. Instead, you buy a specific real estate property and become an owner of the asset. As the owner of the real estate asset, you have more opportunities to increase your tax benefits as a passive investor. In short, a real estate syndication involves multiple investors pooling their capital to purchase a real estate asset. The general partner or syndicator of the real estate syndication finds a deal, coordinates the transaction and financing, and then manages the investment once it has been finalized. Passive investors pitch in most of the capital required in exchange for equity in the real estate. In real estate syndications, passive investors don't have to be actively involved in property management, accounting, or tenant-related issues, making it very appealing to many. A great aspect of real estate syndications is the transparency in your level of risk. When you are a passive investor in a real estate syndication, you know exactly where you are investing, the asset you are investing in, and most importantly, who you are investing with. This allows you to correctly underwrite the opportunity and communicate with your sponsorship team directly through the course of your investment. One of the benefits to real estate syndications is the potentially high returns. A typical multifamily syndication firm proposes an investment model that looks something like this. The hold time is going to be 5 years of owning the asset. The passive income is going to be 8 to 10% cash-on-cash return on your investment per each year. And then the profit on the sale could be 40 to 60% or more return on your investment at the sale of the property. Now, a downside to real estate syndications is the barriers to entry. For most offerings, expect a minimum investment of $25,000. Additionally, unlike REITs, real estate syndications are, in most cases, held under SEC regulation. This puts limits on the marketing of these offerings to the public. Finally, if you do not have a relationship with a real estate syndication company, it will be more challenging to find these particular investment opportunities. But ask around at your next RIA meeting. They might not be in plain sight, but they're not terribly difficult to find either, especially when associating with fellow real estate investors. Now, the third way, the single-family landlord option. This option is going to take more hands-on work up front, but the payoff on the back end is almost always worth it. By taking on the role of property owner and landlord, you're able to receive all of the benefits of owning real estate, like, of course, passive income, but also appreciation, depreciation, and amortization. And then there are the intangibles. You've got pride of ownership, and you've got total control. Throughout the Midwest and the South, It doesn't take any real extraordinary effort to locate a modestly priced single-family home that would produce a positive cash flow, meaning a tenant's going to pay you more than what the mortgage costs you, leaving you each month with a monthly income. By setting a very conservative goal of purchasing, say, just one income property every other year, enough monthly passive income can be produced to pay the owner the nation's median household income in just 20 years. I mean, that's something the average person is failing to do right now, following the traditional strategy of saving money for 40 years. That slow buy and hold real estate plan cuts that time in half and also makes it much more certain. If you wanted to go even faster, you most certainly could. And if you'd like some help with that, along with dialing in the exact number that you need to retire and the exact number of income properties to achieve it, I've got some free information for you. Download an investor's package at cashflowsavvy.com. If you like what you see, you're going to have the opportunity to pick a time for us to hop on the phone and strategize your passive income retirement. And it all starts at cashflowsavvy.com. That's it for now. Thanks for watching. Take care.